last week. I'm going to go through it real quickly just to see if there are any questions, but otherwise it's just a handout for you in preparing for the exam. And we'll move on to the core economic terms. So this is what I attempted to draw. So we've got the main fund here, and this is the general partner. So the fund is the Delaware Limited Partnership, and we're sticking to just the basics. I went a little too far in getting into the parallel payment funds, master feeders. So what we need to know for the exam, and probably for the first 7 years of being a venture capitalist, is on the screen right now. So a Delaware Limited Partnership fund, we have a general partner for that fund. He has unlimited liability. He does fiduciary duty. And then that is typically itself an entity such as a limited partnership or an LLC. So let's not forget that while there's unlimited liability to the general partner, it's really a matter of what bank accounts and assets does the general partner entity itself have, because really it's owned by these guys. The mouse isn't really moving there. So, you know, what the assets of these rich guys run are probably irrelevant as long as they're listening to their attorneys. And we've got the investment manager, who's probably the same individuals behind it. It's also likely set up as a limited partnership or an LLC. We've got a different kind of line here. There's not technically a fiduciary duty. Oh, they're an independent contractor. If they're subject to the Advisors Act, there are some duties that would be applied, but it's only the SEC that can enforce those, and they are not set forth clearly except in case law that's still being established. So we got our limited partners. We talked a bit about those today. They could be entities, they could be individuals. In the portfolio company investments themselves made by the limited partnership. It's the limited partnership, the fund entity that brings everyone together. They all connect to it. What we didn't talk about, and I want to touch on, is this LPAC right here. LPAC stands for the Limited Partner Advisory Committee. It is generally true that the limited partners are limited in their liability to the amount they invest. And it is also true that they maintain that limitation by not exercising control of the management of the partnership. However, it is well established that limited partners can participate in some things. For instance, they can vote on matters that pertain to them. They can also advise the general partner as the general partner requests. So we're seeing an expanding role of the LPAC, the advisory committee. It will be comprised of probably your largest 3 to 7 investors in the fund that like to be more involved, have more information. What they will do is they will, if the general partner wants to make a trade that might be considered a conflict of interest, he needs to disclose it to the partners and get their consent. Well, a partnership agreement can say that that disclosure will be made to the LPAC, and the LPAC will consent. A bit easier to facilitate that way. So if you trust your LPAC, if you're a high net worth individual and you can't get onto the LPAC, maybe you can get an observatory role where you don't vote, but you can sit in on the conversations. Or you hope, well, you should get to the point that you trust those investors that are on the LPAC, because they may be making some decisions that have an impact on the fund while it's not controlling the fund. Yeah.
Can I just ask one question? Jumping back, am I thinking about it correctly if the investment manager is basically just legally a way to protect the general partner from liability in the case of something like that?
Right.
But it's the same people.
Yeah, almost always.
Okay.
You know, so remember, you've got the general partner as a matter of tax efficiency to send the 20% carry your performance allocation that way and keep the long-term capital gains to them. But you want to protect those assets. You also want to protect the 2%, which could be just as big depending on how much profit they're able to take over there. Keep them separate because they will have their separate creditors, their separate liability. If you decide that you have some portfolio managers that they don't own equity in the general partner, or you know, you don't consider them your partners, but you want profit share with them on a tax efficient basis, you might throw a fourth person into the general partner, but not have them be part of the investment manager. And you might give them only equity rights without vote. So, but basically, it's a mirror, and they're two legal fictions that just create limited liability. They may even operate out of the same office and have to think before they realize which entity they need to sign for.
Sure.
Just a reminder that the general partner and the investment manager I tried to make this so that triangles were limited partnerships, the GP is usually a limited partnership, or an LLC. And we talked about why. Again, you have these notes. Again, the drivers of fund structure are the investor demographic concerns. Are they high net worth individuals? Are they tax exempt foreign investors? Or are they a public plan? That will determine how they want to go in, whether they have concerns about the more complex structure and the investment manager being a separate entity. The tax efficiency explains the use of the GP and the allocation of the 20%. Efficient tax administration is when we talk about perhaps putting in a blocker entity so that you can save your investors the time of doing taxes. Limitation of liability for both the general partner and for the limited partners. And while it's definitely not the last factor, it's going to be the last of my four. The regulations with a lack of various jurisdictions. So as an investor for a public plan, I feel much more confident in the Delaware limited partnership, where I understand the law and how it's going to be applied, than perhaps in a changing environment of the United. Limited partnership funds, again, pass-through tax status, tax-efficient allocation of long-term capital gains to the GP, limitation of liability, unlimited liability for the GP. Go through that. So, just to reemphasize, an LLC serves the same purpose as a limited partnership with one additional option of flexibility, which is that it can have all members and they can all be completely limited in liability. When you have it in the fund setting, you'll have one of those members actually take on the role of managing member, which is identical to the GP. They're taking on the unlimited liability because no one would deal with them in the fund setting if they did. So, interchangeable LLC and limited partnership. Okay, now talking about the documents we went through, limited partnership agreement. This is the biggest agreement, the most important one for the entire relationship. They'll govern the management and operation of the fund. Again, not the investment manager, this is just a contractor. All of the rights and responsibilities of the GP and LPs. It creates the legal entities, which I described as a fiction, giving limited liability. The core purpose of the partnership agreement is to set out, I need to say the parenthetical, in excruciating detail. These are 120-page partnership agreements oftentimes. What the rules of the road are going to be, strategy, the term life of the fund, how funding and capital calls are handled, what the standard of care owed by the general partner, and perhaps the LTAC members are, how interest could be transferred in the secondary market or not, the default provisions, management and control, distribution rights, how the cash is eventually given out to the partners and in what priority, the economic terms, the bargaining, voting rights. Some variations on partnership agreement by strategy. Venture capital funds are going to have they're going to have tighter investment restrictions and diversification limits than buyout funds because of their smaller size, the riskier nature of the assets, and the smaller size of the total commitments to the fund. Can, like this, venture capital funds may have a higher management fee because they still have operations. Their investment operations will require X million dollars, even though they're running a $10 million fund if they want to diversify. Venture capital funds, at least at the early stage, and tell me if you disagree or have additional comment. Venture capital funds at the early stage usually don't use leverage, and it's unlikely that leverage limits are addressed in much detail or there'll just be no leverage allowed. Is that your experience?
That's been my experience, except there used to be 10 years ago the SBSC funds where they were leveraged by the Small Business Association. So like East Springs First Fund, for example, which is a big fund in Salt Lake, was $40 million of limited partner money and $80 million of SBA money. And they got a leverage mechanism where SBA got a preferred return and the individual invested. I haven't seen them on that.
The larger buyout funds, I'm sorry that I use a mega fund in here, but my kids are in the mega fund right now. Due to their overall size, should have a lower management fee. Obviously, it's going to depend on what the management fund is and if they can charge that higher fee, what the operational complexities are of their business. And then buyout funds bring this issue, well, it'll come up in all funds, but there's the issue of transaction fees, and we'll get into that in today's lecture. Outside of the management fee that's paid by the limited partners and the performance allocation that's paid out of profits, there may be other sources of income that the general partner gets, and that usually has to do with their level of involvement in the portfolio companies, the investments themselves. They may serve as directors on the board and get a fee for that. They may negotiate in their deals as it's going along that if the company backs out after a certain stage, that company pays the GP a deal break fee. And there are some questions. How should that fee be handled? Should the GP be able to pocket it because they were sitting on the board? Should that offset the management fee, or should that be income to the fund? We see it all ways, and it has interesting effects depending on how it is applied. I talked a little bit about credit opportunity funds. So we're focusing on private equity, but I do want to continue to stress that this is really about the liquidity of the assets of the strategy that you focus on. So if you as a general partner decide that you could put in money into a pharmaceutical company for a specific product, and say you put in $10 million and you're able to clip the first 5% of income annually on that particular product, you basically created a debt instrument where you're making your investments and clipping coupons as opposed to trying to realize the deal by selling the company later on. So that would be a credit opportunity fund. They might have shorter investment periods instead of going 5 years where they buy and then start to wind down and realize assets. They might be able to put all the money to work in 2-3 years and just clip those coupons for another 7. We'll skip real estate because I don't want to taint your class too much. Finally, what if your investment manager, your general partner, also has other related services that they offer? We see this where investment managers will set up. Well, let's say that's too big a conflict. Let's say that you have a general partner, you have a firm that they're investing in tech venture capital, and they also decided that it would help their companies out a lot and help make their investors money if they started another business too. And what this other business does is online solutions for early stage growing companies for accounting systems, for whatever it is they might need. And these companies sign up for the services that your general partner offers in revenue. So how would you as a limited partner view those fees? Should they be kept by the general partner and be allowed to run that business at the expense of your portfolio company? Or should those fees be part of an offset to the management fees, or should it be a combination of split? See your eyebrows being raised there, huh? The investment management agreement is the agreement between the fund, partnership, and the investment manager, making the investment manager an independent contractor and setting forth what responsibilities the general partner is delegating to them to do, and how much do they get paid for. The subscription agreement is oftentimes the only thing the investor signs. Technically, you have to sign the partnership agreement to become a partner, but through the subscription agreement, you make all of your representations saying I'm accredited, this is what type of entity I am, I'm not laundering money, here's information on my trustees and our bank accounts, and by the way, I grant the power of attorney, Mr. General Partner, to sign the partnership agreement for me in its form that it is in on the day you sign the subscription agreement. So thereafter, any amendments that come to you, it's just as if you signed the partnership agreement. So that's how you sign up for your commitment. Private placement memorandum, aka confidential offering memo, aka offering memo, aka prospectus, all the same thing.
Do you make investments in funds that don't have a account, or your funds also very
Our funds would have to, because it's a requirement under Reg B, so to be able to offer private securities, if you're raising more than 1 or 5 million, you got to meet those requirements. If you're raising less than $1 million, you fall under state law instead of SEC private investment law. But you do have to put forward otherwise, and it needs to contain all of the material aspects of the partnership agreement and strategy. But this is not something that you want to rely on for your legal rights for the partnership agreement. It's a good summary usually. Then you may have a side letter agreement with the fund and or the general partner and or the investment manager as an investor that sets forth the bespoke terms that are unique to you. And the guarantee, which is the financial guarantee from the general partner that if, when all is said and done, it turns out that the money they got is more than 20% of the profits they promised, they will give it back. There are a couple quirks to that with taxes, and you may only get back net of what the duties already paid taxes. So that's last week's lecture in